Hi, good afternoon, everyone. Thanks very much for joining us today for a Netwealth webinar. We're just waiting for a few more people to dial in and then we'll get going shortly. Okay, thanks everyone for joining us today for this Netwealth webinar. We're going to talk about some of our views about global investment trends and the perspective of how our investment team is thinking about the world at large and what it means for the Netwealth portfolios. I'm pleased to be joined by Louisa Gaynor, who's our Senior Client Advisor. I'll run through some slides and talk about our views, and then we'll head on to answering some questions. And hopefully between the two of us, Louisa and I will be able to answer those. Thanks very much to those of you who have already submitted questions. Hopefully we'll answer a few along the way. We will have some time a little bit later on, so if you'd like to, please do submit some questions through the course of the presentation, and we'll address those that we can towards the end. So without any further ado, I'll kick off. So I think the first thing that we want to focus on is the outlook for inflation and what it means for interest rates. So you can see on this first slide, the overarching concern for markets has been what has been taking place with regards to inflation over the past couple of years. And the good news is that inflation rates are normalizing after that big spike over the past couple of years. Now, markets want to analyze all the different sorts of nuances around the outlook for inflation, but the overarching message is that the inflationary impulse has passed and central banks are going to be able to respond to that. In fact, in the UK, medium-term inflation swap, which reflects the cost of protecting against future inflation, is now the lowest it's been since 2016, which is going to be really impactful. And in the Eurozone, we're seeing much more muted wage growth, around 3.6% in the second quarter. And against the backdrop of low growth, the European Central Bank has also moved its focus. The key, however, as always, is really what the Federal Reserve is doing in the US. And so if we look at the US interest rate picture, this chart shows us the level of US interest rates, the dark blue line, and then the path of future rates that has been taken in green at the start of January, in yellow at the start of July, and then the lighter blue line is the current picture. And you can see that the US interest rate cuts really been put on pause through most of this year as the strength of the US economy surprised markets. On Friday, however, we had some pretty big news from the head of the US Federal Reserve, the US Central Bank, Jerome Powell, who he said very explicitly that he thought that the time has come to move policy in light of what he called unmistakable cooling in the labour market. And that's from secular sort of tight levels. So inflationary pressure has come down, and now the Federal Reserve is cognizant that the heat that was in the labour market that made them fearful of future inflation has also started to cool off. So the messaging is very clear that the Fed intend to start cutting interest rates, and it's very likely that they're going to do that at their next meeting a couple of weeks in September. And the market believes that the path is going to follow quite a normal one, so it's pricing in about 2% of cuts from the current level over the course of the next couple of years, and that's a relatively normal route to take. But it does suggest that it's a little bit stronger moves than a very healthy economy would otherwise warrant. So that's where the little bit of tension lies in the US at the moment. If we think about Europe and the UK, they've already started the process in earlier in the summer, in June and August respectively, and the European growth picture is much weaker than the US. In the UK, there's been quite a lot of good news on the UK economy this year. GDP performance of economic growth has surprised in a positive way. and that's been based on industrial construction spending. Unemployment remains low, but the wage growth is gently slowing. So we expect quite a gradual change in rates there. In Europe, the growth picture is more challenging. A couple of the key economies are visibly struggling. So the ECB didn't take rates as high as the other economies, but we think that they're going to carry on sort of reducing them in a pretty stable way. Japan, which we follow quite closely as well, is a very different backdrop, and they're taking tentative steps to normalizing policy rates in the opposite direction. So thinking about how they can lift the interest rates you get in Japan. So very quickly, why does this all matter, and why is it so difficult? Well, a good example is the cost of borrowing that householders face. This chart shows two different lines. The more sort of volatile dark blue line is the current interest rate that US house buyers will need to take on if they're entering into a new mortgage. Now, US mortgage market is slightly different than our own. They have longer dated fixed rates. So this is a 30-year fixed mortgage rate, and you can see that it's took a big spike as interest rates increased over the past couple of years, reaching up to 8%, and is now starting to come back down. Now, why the picture becomes more challenging is that the more stable light blue line is the prevailing rate for outstanding mortgage debt. And you can see that big difference between the interest rate that people are paying on existing mortgages versus the current one. So now the average rate is starting to gradually climb higher, reflecting new interest rates even as they come down. So the impact on the economy can be quite variable, and it takes a long time to pass through, and that's the challenge that is facing policymakers. So how do we think this is going to impact onto markets and our portfolios? Well, just as a quick recap, we run multi-asset portfolios ranging from low risk strategies and risk level 1 with low potential return, moving up the spectrum to risk level 7, which are more suited to investors looking for growth, where we expect the potential return will be higher, but it comes at a greater rate of volatility or short-term risk of loss. We have three main pillars to the investment approach, for those of you who haven't heard this before. The first one is picking those strategic allocations, the main building blocks that make up our portfolio exposures. The second one is instrument selection, how we fill each of those one components. And the third one is cyclical positioning, how we adjust our portfolios through time. Now, we use those three main components of the process in concert together to change the way that portfolios are invested over time, but we're not moving about exposure in a dramatic way day to day. We don't believe that's the best way to add value. The key part of a multi-asset investment process is thinking about the way that your different investments fit together. And our key building blocks are equities and fixed income. We use those because the drivers of return are very different. So quite often, these asset classes will behave in different ways to a changing environment. This chart shows what we call the correlation between global equity and US Treasury bond returns. So if these colored bars are above zero, it means that the asset classes are working in a similar way. And if they're below zero, it means that they're offsetting each other quite nicely. Now, it's more helpful if correlations are negative, but you can see that that's normally the case. But recently, that inflationary impulse meant that the relationship had changed. So high inflation and higher interest rates was bad news for equities and fixed income. And then we've seen policies start to change and people become less concerned about inflation. It's been good news for equities and fixed income, but the correlation has remained positive. And you can't quite see it, but at the very far right of this chart, you can see that actually this has moved back down to zero. So that lack of positive correlation really is a good thing for us. It means that the different drivers of returns are going to be working in opposite directions, or certainly not working together. And so in addition to our other diversifying asset classes, such as commodities and trend following funds, we believe that this has sort of broadened out the appeal of multi-asset portfolios. The second point I wanted to follow on from that is that just as the way that assets correlations is an important part of our risk management and monitoring process, we also have to be aware of what risks we're willing to take on. Now, this chart shows the returns that you've seen in different calendar years, going back to 1999, from a global equity index. The navy blue bar shows the calendar year return in any given period, whereas the green line shows the biggest intra-year drawdown that investors would have seen. So the takeaway here is that over 17 of the past 24 years, you've seen positive returns by investing in global equities, and the total return has accumulated to something like 300% in US dollar terms. So really strong period for returns. But even in that strong period of returns, also in 17 out of those 24 years, you've had a drawdown of more than 10% within the year. So we think that accepting a degree of market volatility is really the entry price for investing. And it's the entry price of meeting those longer term goals that investors have. Understanding this is a very important part of the risk management for our investment team. So those are the sort of strategic concerns that we have about investing. When we think about where we sit currently, we're looking here at the returns that you've seen at the end of rate hiking cycles. And we use this slide to retain the perspective of how powerful interest rate changes can be from the point of view more fundamentally of how it impacts businesses, but also more sort of mechanistically of how markets respond. And so if we think about the returns that have been generated in the months following the last rate hike of a cycle, so in our case, July of last year would be an example, you can see that typically all of these major asset classes deliver positive returns, whether you're looking at 6 months, 12 months, or 24 months. Now, of course, as we sit here, you've already seen some more than 20% returns from US equities since that last interest rate hike. So we know part of that is already sort of baked into market pricing at the moment. You've already seen positive returns of about 6% from both cash and treasuries. But we also then look to the right-hand side of the slide, and you can see that after the first cut, there's also some positive subsequent performance. Now, these periods might overlap a little bit with the first chart, but it gives us a good sense that being invested in periods like this has historically been beneficial. And most interestingly is that US Treasury bonds, so high quality bonds, beat cash, and equities beat treasuries. So we try and keep that in the back of our minds, even when thinking about some of the more volatile periods that we're certain to see in the future. Now, of course, the context of what is driving interest rate cuts is really important. So it makes a difference if you're having a gentle, benign easing of inflation, and that's very different from a more recessionary environment. Now, some investors have been looking out for a US recession for a long time. It hasn't materialized. Nothing is guaranteed, but you can see that there's been a range of returns over different scenarios from each of these asset classes. That's sort of represented by the gap between that green bar and the yellow bar down at the bottom, the maximum minimum around that average return. But in all environments, it's generally been a positive tailwind to generating investment returns. So overall, our main view is that it's a pretty benign environment at the moment. So what is driving our key investment views at the moment? Well, the first one, we think it's super important just to stay diversified, and our portfolios are the most diversified that they have been. We're very aware that bond markets are still really focused on that inflection point between inflation and growth. Now, our colleague, Dr. Jared Lyons, has spoken previously about how he thinks that market concerns will transition from worrying mostly about inflation onto the outlook for growth, and then possibly after this stage onto the outlook for overall levels of debt that's in the global economy. We're still in that sort of transition between inflation and growth at the moment. So that's where bond markets are responding really positively to the outlook for interest rates. Equity market performance has been pretty strong. It's, of course, been quite narrowly focused on certain parts of the US equity market, which we can come on to in a bit. But the good news is that it is broadening. And we're also very aware that equity markets have the opportunity to sort of climb that wall of worry. There are always points of concern that we see both at the world at large and also within markets, but historically it pays to be invested, and investing over time tends to produce the gains. So you're climbing that wall of worry. In the short term, for equities, we think that earnings are going to be key. That's what has really supported the US stock market. We've seen really strong earnings of profit delivery so far in the past couple of years. We've come to the end of another profit reporting season, and it's largely been pretty positive. What has been a little bit different is the outlook from certain companies is changing, and we can speak about that in a little bit more detail. In Europe and Japan and emerging markets, our other major building blocks really need to see a catalyst for growth. These markets are cheaper. They're being seen as being cheaper for a reason at the moment, but we need to see where their earnings growth is going to come from. And then always at times like this, we're looking at the short term, but we're also trying to stay focused on the longer term concerns as well. We need to maintain that strategic balance within our portfolios. We want to make sure that we've got enough structure within the investment process, but also flexibility to respond to a changing environment. The long-term questions that markets are looking at are: where are interest rates going to settle? Have we seen a real structural change in the rate of interest that's going to be applied? And are you going to see a change in market leadership within equities? Most importantly, perhaps on an operational point of view, is that we continue to focus on making sure that we are investing portfolios in a cost-effective way that can really make sure that those attritional costs are taken out of our investment process, delivering more of market returns onto clients. So in the short term, everyone's focusing, as they have through much of this year, on the impact of the US election. So the chart just shows the way that the betting sites are gauging the potential for Republican or Democrat victory, and you can see that after this sort of bounce, as Biden confirmed he wouldn't be standing for the Democrats again, and Harris has really sort of come in and reinvigorated the Democrat message. The outcome really looks finely balanced. So it's too close to call at the moment, and is likely to come down to a few battleground states. So when we think about what the market implications are, there are clear differences in both fiscal and foreign policy. We would think that markets will see will struggle to get through to the nuance of some of Harris's messaging on the economy. We know that she is trying to address the cash-strapped middle classes. Some of the measures that they're proposing to address that are going to be less market friendly than others. So talk of price controls is not going to be well received by the market, but proposed tax credits could well do. Corporation taxes are suggested increase from 21 to 28% is not going to be something that that markets like. And we think that the other idea of taxing unrealized capital gains appears sort of overly interventionist, and we think that that could be quite difficult to deliver effectively. There's still quite a lot of ground, we think, to go between here and November, where some of those policies might be sort of tested a little bit. As far as Trump goes, we think that investor sentiment would be boosted by the prospect of extensions of the tax cuts and higher fiscal spending, but we think that these are going to be slightly less impactful than 2016. corporation taxes, have fallen a little bit already. So we're not sure that the further cuts are going to be as impactful. We think that financials will get quite excited about this, the language around deregulation, but markets could be a little bit nervous when he speaks about intervening with regards to the Federal Reserve. When we think about the performance within the US market, I think that smaller companies and more domestically focused stocks would benefit in relative terms from talk around action on tariffs, which will probably be a net negative for market performance. But we need to be aware that some of the higher bond yields that people associate with greater fiscal spending would also put a little bit of pressure on equity market returns. And if we think about immigration and what's likely to happen there, markets are also a little bit concerned that might have an impact on wage pressure as well. Having got past that lump of the inflationary impulse, people don't like the idea of wage pressure forcing inflation higher. So digging into the US a little bit more on equity market terms now, we're focusing on the US because it is the most important equity market in the world, and we think that it's been the characteristics of what has happened have been particularly interesting. Now, there's been a distinct change in market leadership in the past couple of months within the US. So even though the broader equity market returns, which you can see on the right-hand side of the slide there, have still remained positive, whether you're looking at the first 6 months of the year in the dark blue color or the lighter blue color of the performance since June the 30th. Returns have been pretty solid over this period. But what's been happening underneath has been really quite interesting. If we look over towards the left-hand side of the page, you can see that cyclical sectors such as energy companies or companies that are relying on discretionary consumer spend did pretty well in the first half of the year. They're trailing a little bit post June the 30th as people are a little bit more cautious on the direction that the US economy is taking. In the middle, however, defensive sectors, and here we're thinking about utilities, healthcare, aspects where consumer spending is more sort of predetermined, when we call them consumer staples, are performing really quite well compared to the broader index, and it's been a good year as a whole for these types of companies. What's really notable, though, is the change around communications and technology names. Now, you'll have heard of the Magnificent Seven and the way that these stocks have dominated index performance. Their ability to produce outsized profits over an extended period of time has meant that valuations here have crept up really quite significantly. What we've seen since the end of last quarter is that the market is growing a little bit more skeptical that these stocks are going to be able to produce those same results in the future. So even though the margins have stayed strong, some of the company outlooks have been a little bit more muted. And the market has responded to that by saying that they don't think that these companies should be valued as highly. So you can see, even though there's a very small negative performance there, you can see there's quite a difference compared to the broader market or those other sort of types of sectors. So there's been an uptick in market volatility. We think it's quite healthy that the market performance is going to broaden out beyond these names. As ever, we're waiting to hear on what the latest update is from NVIDIA, which comes out tomorrow, around their view on the prospects for AI spend that's been so rewarding historically. But it's definitely something to keep an eye on in terms of what is actually driving portfolio performance. The last aspect I wanted to talk about was our alternative investments. This chart shows the relative performance of industrial metals such as copper, iron ore versus precious metals. So as that line goes up, it means that industrial metals are outperforming. As the line falls, it means that precious metals are outperforming. And you can see that over the past 15 years, the demand for gold, and we've spoken about gold quite a bit and previously, which is trading at record prices currently, is far outstripping the demand for more productive assets. Industrial metal prices are depressed thanks to a pretty negative outlook from the world on the Chinese economy, keeping prices of these assets low. And for us, this is quite interesting just in of itself. Our allocation to gold has been performing very well. Our allocation to broader commodities, a little less so. But seeing this relationship change should give us early warning if the environment for global industrial growth is changing, and as people get a bit more upbeat on the developing markets such as China. Before I speak about the performance update, I just wanted to show the broad characteristics of our investment portfolios. Here we're focusing on our sterling range. We do offer portfolios in euro and US dollars as well. You can see that gradually, as we move from the lowest risk portfolios over on the right, the allocations change, increasingly exposed to government and a little bit in corporate bonds, but we don't find them particularly attractive at the moment, and alternatives, before then going into global equities as well, as we move up the risk scale. You can also see the currency allocations are down there at the bottom as well. Typically, we make changes to portfolios at the sort of sub-asset class level, rather than dialing up and down the exposure to fixed income as a whole or equity markets as a whole. So the changes get made under the surface there. We wanted to give a quick update on portfolio performance before we head to questions. You can see here from this colourful chart that investing in the more risk-seeking portfolios has generally been a positive experience. So even though those lines of performance are a little bit more volatile, they've been more rewarding through time. We're pretty pleased with the way that the annualized returns are stacking up since launch in May 2016, and the past year has also been a pretty positive experience for investors. When we think about how that compares to our peer groups, we find that generally we've done a pretty good job against peers. We attribute that to making sensible decisions around asset allocation, not throwing around portfolios too aggressively, but the most important part is executing in an efficient way, keeping costs low and passing greater market returns onto clients. This chart we use as slight validation. Apologies if it's a little bit small to pick out, but the overarching message is that this is the performance of our portfolios against individual peers as monitored by the asset risk consultants, a well-known group of consultants operating in the UK wealth industry. And essentially the y-axis here is the performance that's been generated over time, and the x-axis is the volatility that has been withstood in generating those returns. So really you want to be towards the top left-hand side of that chart, and we're happy to see that our portfolios are really on the cusp of that top quartile performance over time, above the peer group, and generating those returns with less volatility, and that to us is a vindication of the way that we seek to manage money. If we skip through these, you can see that again on all the different calendar year periods. I would just draw your attention through to the period on the right, which shows those annualized returns of our portfolios versus those ARC peer groups, and they range from about 0.5% up to 1.5% over time, depending on the risk level. But we're generally pretty pleased. That's all I was going to focus on just now. Perhaps Louisa, if you can rejoin, then we can answer some of the questions that we've had.
Yeah, that would be great. Thanks, Ian. So I've just been keeping an eye on a couple that have come through as you were speaking, and also to those of you who kindly submitted questions beforehand, thank you for that. There's one here that I think I'll start with, particularly given your conversation around performance and the instruments we use within our portfolios. They've asked, is it worth trying to beat a low-cost global tracker fund?
That's a great question. I mean, from our point of view, it is. We think that a tracker fund is a great starting point for investing because it captures the most important aspects of what we think are most important. The first is tracker funds are low cost, so we think that minimizing investment costs is super important. Now, Netwealth as a company uses technology to do that, but also the investment costs of investing in ETFs and other passive instruments as the starting point for our portfolio. So that's important. The second point, I guess I would agree with, is that it provides diversification. And as you can tell from the presentation, we focus on that a lot as well. I think the point that's a little bit different about a global tracker is that at times it gets you overexposed to particular areas that have been particularly well performing in recent history. Now, we saw that most clearly in the beginning of the 1990s when the Japanese market had gone through a period of astounding growth and was the dominant factor driving market exposures, and before then, underperforming for about 30 years. And we also saw that in the tech bubble that the US sector underwent at the turn of the century. And in the period following that, US market underperformed for a good 10 years as well. So we think that global markets sometimes just travel too far and result in too much exposure to one particular area. Now, they start off being diversified, but getting bumped around by market movements really can distort that. So we try to make sure that we've got a real strong handle on different drivers of returns within portfolios, and we think that that's ultimately a good call to make sure that someone is looking at those exposures from a fundamental point of view.
Thank you. And then kind of slightly related to that, more specifically around the portfolios, we've had a question in looking at our higher risk portfolios, so risk level 6 and 7, the GBP portfolios. It's been pointed out that they obviously have quite high exposure to the equity markets. And is that a fixed exposure, or is that something that's likely to vary through time?
It's not necessarily a fixed exposure, but we believe that if you're operating at the higher end of the risk spectrum, and these are clients who have chosen that level of risk, you are going to want to focus on equity markets. Equities have historically been the leading driver of returns. They've got the highest historic performance, and if you think about trying to capture global growth and innovation and everything that that companies work hard to do, it makes sense that they're a very productive asset class. So we think that you if you're investing for a long period of time, as our risk level 6 and risk level 7 investors are, then you should have a significant weight to equities. So it will be high. It's not necessarily fixed, but as things change through time, but we are very unlikely to be stepping away from equity risk in a meaningful way on those portfolios. We think it's really difficult to time getting in and out of market exposure, when it's much better just to say, okay, I'm investing for the long term. I'll take what the market has to offer in that regard.
Yeah, and I think actually, the advisory team are certainly happy to sit down with any clients or anyone interested in our portfolios to talk through the different risk levels. I mean, you already showed that we have 7 GBP portfolios, and if you feel that the higher risk levels have too much equity exposure for you, then that's when you want to look at the slightly lower or more moderate risk level portfolios. So risk level 4 is, just under 50% in equities, and we go right down to 1, which is really actually just more of a cash-like portfolio. So certainly the theory being that there is something in there to meet all your goals and your attitude to risk. Um, and then I think just I've seen a question come in which is slightly more towards the financial planning side of things. It's a bit of a tricky one to answer. It says, what are the risks and timelines of the 25% tax-free drawdown being abolished by the Chancellor? So I think I'll take that one if that's okay, Ian. And I think the first thing to say is that although there has certainly been some hints as to that could be what will happen, there's not enough evidence for us to plan around it at the moment. We know that actually, Keir Starmer did do a speech today at Downing Street where he was signalling that there would be some tax rises and also quite a painful budget. But we can only plan around the rules as we currently know them. What we do know is that pension legislation is incredibly complicated, and so it is unlikely that any changes to it would be made with immediate effect. So that would likely give us and our clients a grace period where we could plan around the rules that they were proposing before they actually implemented them. And so that's certainly what we'll be looking to do. And quite often as well, what we see is that in the lead up to the budget, so in the 3 weeks before, so the budget's for the 30th of October, so in the weeks before that, they will often leak the content of the budget so as not to shock markets. And so certainly once we have a better idea of what may come up, we'll be reaching out to clients and anyone that's interested, and we'll certainly be running some webinars on that as well. So would certainly suggest attending those if you're able to do so. But just quite conscious of time, and there's been a couple more questions in, Ian, if that's okay. There's one here on around UK markets. So there's been a lot of movement and activity within UK markets. Could you provide some insight as to what you think is going on here at the moment?
Yeah, of course. So the UK market is an important component of our portfolios, and we like it particularly because it works so well with the US market. They've got quite different characteristics. So if you're investing in global equities, you're trying to make sure that you've got things moving in different directions. So while the US market focuses a lot on growth and innovation, the UK market is characterized really by the stability of its company. So there's a big exposure to the energy sector and materials, and there's also quite a big exposure to dividend paying stocks. So that makes it slightly more defensive at a point in time when people might be worried about a bit more volatility in the global economy. And what we have seen recently is that the market, having been very unloved by global investors for a long period of time, resulting in very sort of attractive valuations, has started to pick up a little bit. People are starting to see a little bit more, or think they're seeing a little bit more stability in terms of the political backdrop. There's been positive surprises from UK GDP growth, a stabilization of inflationary pressures, and just relative to other regions, the outlook seems a little bit better. The point about dividends is an interesting one because that provides that level of yield that can be relied on a little bit more than earnings growth at times. But what we're also seeing is that a lot of private market interest is coming to take a look at some of these cheap valuations. And also the people that run UK PLC are also seeing attractive valuations. So they are actually buying back their own stock. Now, in the short term, we think that's a pretty positive move because it gives a little boost to share price performance. Longer term, it's something you need to be quite mindful of because it means that the market itself is just going to be getting a little bit smaller if too many stocks get taken out by private equity, but also if the share count of existing publicly listed assets gets shrunk too much. But on the whole, we think it's attractive. It's working quite well at the moment, and we're pleased with what we're seeing in terms of the way that the market is developing.
Okay, thank you. That's really helpful. And I've just seen one that I'll take come in around defined contribution pensions. So it's asking if you have a defined contribution pension, do you have to transfer this to a SIP or to draw down when you retire? And a defined contribution pension or a money purchase pension is effectively where money is paid into your pension pot by you or your employer, and that money is invested. And the value of that pot will then go up and down depending on the performance of your investments. So a SIP or a personal pension is just a another type of defined contribution pension. So actually it means that there is no transfer necessary at retirement. If you have a defined contribution pension at retirement, you can then either choose to access it via flexi access drawdown or by buying an annuity or a combination of the two. And what you choose needs to be what works best for you. So a more cautious investor, perhaps with a lower level of income requirement, may choose to purchase an annuity because then they've got that guaranteed income through the rest of their life. But those who are willing to take on a bit more risk, perhaps want the opportunity of targeting a higher level of income and more flexibility around when they take it, they may prefer to go for flexi access drawdown. But appreciate is a complicated area and one that's quite hard to cover off now. So if you would like to discuss your specific circumstances or your options and what may work best for you, please do feel free to email us at advice@netwealth.com, and we can arrange a meeting and very happy to have that initial consultation. So I think that pretty much covers off that one. And then I can't see that any more questions have come in, Iain. So I think that is everything from us, unless there's anything you wanted to add.
No, not at all. Thanks very much, Louisa, for monitoring those and for helping us answer them. Thank you, everyone, for joining. Really appreciate the time that you've taken to attend this. If there are any questions that you have about anything that we've said today, or about your net wealth portfolios, or anything else that you'd like to get some guidance on, please do get in touch with the team, as Louisa mentioned. Beyond that, thanks very much again for attending, and we hope to see you soon. Goodbye.
Thank you. Goodbye.